In this video, we're going to learn about expectations. Specifically, we will start off with expectations in the financial markets, which we will focus on the stock market and the bond market as to how the value of stocks and bonds are driven in huge parts based on expectations of current and future activity. So that's our focus for today in this video. And in the next upcoming two videos, we will cover expectations about consumption and investment and expectations related to output and policy. Yeah. If you remember one thing from this entire chapter, it would be that expectations about current and future activity determine the bond and stock prices. Yeah. Um, Many of us may have an experience investing in the bond market. Many more of us might have invested in the stock market. And we might wonder what causes these prices of these stock market um, participants or stock market companies or stocks or specific bonds to change. It comes down to expectations. So let's learn how that's the case. Yeah. To recap, let's get to some basics. And the first concept that we need to recap is the discounted present value. So if I, let's say, invest $1 this year, if I invest $1 this year, next year, with some amount of interest that I can get, I will expect to have $1 plus something more, which is the interest on that dollar. Yeah. So if I were to do the opposite, which is $1 into the future can be discounted in present terms or expected present discounted value to be 1 over 1 plus I. Yeah, if you can go from $1 to 1 plus I dollars in the year from now, then $1 a year from now would be equal to 1 upon 1 plus I. So that is in a sense discounting. How can you convert the dollar into the future into today's terms? Because if you compare today's dollars with tomorrow's dollars, then you're comparing apples to oranges. So when you look at present value, what you're doing is you're converting all of those future dollar values into your current dollar values. So now that we understand this basic concept, we can go and enhance this understanding. $1 now, 2 years from now, not 1 year, 2 years from now would be $1 a year from now, which is 1 plus I, times whatever that value that we have, it would have the interest of a year from now as well, because it would have the first year's interest and the second year's interest. Yeah. So interest a year from today. Yeah. So similarly, $1 2 years from now is worth 1 over 1 plus I times 1 plus IT plus 1. Yeah. So far with me? If you get interest in year T as IT and year T plus 1 as IT plus 1, that's the value of dollar in 2 years. So if you understand 1 year and 2 year, what we can do is we can express this in nominal and real terms as well, because what I've done so far is use all nominal terms. So the key takeaway, folks, here is that the present value of sequence of payments, I've just used one payment, a year from now or 2 years from now, one payment, is expressed in dollars discounted using nominal interest rate, and then you divide it by the price level for today. Yeah. The present value of sequence of payments expressed in real terms, discounted using real interest rate. So what I've done so far is nominal, but I can do the same in real term. And what I have done here, folks, is I have looked at not just 1 year or 2 years. I've looked at n years. Yeah. So if you look at this, you can expand this series into n years. And if you use I, then the nominal interest rate. But if you use substitute R, then it's real interest rate. And you can also have an expected value associated with the price at that point. Yeah. So what we've done with 1 year, with 2 years, we can do it for any generic year. So if you substitute t by 1 or n by 1, you will get the same equation. Yeah, in terms of 1 over 1 plus I, that's what you will get in the setup. Yeah. So in a sense, we are able to look at this from either nominal terms or real terms, and we are able to calculate present value. If we can do this, folks, if we understand the present discounted value, then we are able to understand expectations. Because a lot of this, if you start to see, there's this exponent e, which basically says there's some expectation around what this value would be into the future. Because if you invest in stocks or in bonds, you know that the price will go up and down, and whatever your expectation is, based on that price, you will get some amount of dividends or some amount of fixed coupon payments when it comes to bonds. So this understanding of discounted value is connected to expected value or expectations, because based on your expectations, you will get the return currently. Yeah. So expectations about the current and future activity determines bond and stock prices. That's the key takeaway. And we're trying to understand discounted present value. And now let's look at bonds and bond markets first, and then we'll get into stocks and stock market. So for bond markets, we first need to understand the bond market vocabulary. There are a lot of terms that we will use. So let's recap some of them. A government bond is a bond that's issued by the government. Yeah. So US Treasury can issue bonds, and when they issue bonds, they can get money for in return, and they can use it for government spending. Corporate bonds are bonds issued by corporations. Apple, Microsoft, all of these big corporations can issue bonds, and in return, they can raise money for investments. Bonds are rated, and their rating agencies, Moody's and several others, do rating. So ratings are done to assess the risk of default, which is nothing but whether this issuer of this bond, in this case, if it's the United States government or a specific country's government or a specific company, whether they will actually default. The higher the chance of default, the lower the ratings. So a default is, in a sense, whether they'll make the payments that they promise that they will make. Risk premium is the difference between interest rate paid on the given bond and the interest rate on the bond with the best rating. Yeah. So if you, let's say, buy Apple corporate bond, and if you buy some other small company, let's say Zoom corporate bond, you will have to pay a higher risk premium for Zoom, because Apple is rated much higher, assume in this case, compared to Zoom. Then Apple will have a lower risk premium, lower risk profile compared to Zoom. So risk premium is that difference. Junk bond is a bond with the highest default rating, highly likely that they will not pay you your money back. Discount bonds are bonds that promise a single payment when they mature, and they will pay you that value that they pay you is called the face value or the par value, and that is what they promise. So in a sense, let's say a discount bond will pay you $100 in a year, and it's available today at let's say $90, then they'll pay you $10. Yeah, so you get about $10 interest. So that's a discount bond with one payment. The par value is $100, and you get $10 of interest. Coupon bonds, bonds that promise multiple payments. It's not one payments when they mature, which is the face value, but it's multiple payments. It could be yearly, monthly, quarterly, based on the agreement of the bond issuer. Coupon payments are the payments done by the bond issuer before maturity. Yeah. So if you have a coupon bond, they'll make coupon payments, and they'll have a rate, a coupon rate, the ratio of the coupon payment to its face value. Yeah. If it's $100 face value or par value bond, and if they pay you $10 as coupon payment and let's say they just make one payment, so it's a discount bond, let's say. So you get the ratio. The coupon rate is how much coupon or how much interest are they paying you per coupon divided by the face value or the par value. Current yield, the ratio of the coupon payment to the current price. Remember, the price keeps changing, the face value, the par value doesn't change for the bond. So current yield is the ratio of the coupon payment to the current price. So that keeps changing. Life, the amount of time left until the bond matures. Yeah. So every bond has a specific duration. So let's say Apple or United States, when they issue a bond, they'll say, I'll pay you back after X years, or that X years is the life of the bond when it matures. Treasury bills is government bonds with less than a year of maturity. Treasury notes, 1 to 10 years of maturity. Treasury notes is 1 to 10 years. Treasury bonds is more than 10 years, 10 years or more. Premium, term premium is the premium associated with longer maturity. If you hold a bond for longer time, then you have to have pay higher premium because there's time risk associated with it. So that's the term premium. Index bonds, bonds that promise payments adjusted for inflation. And in that case, the example of that would be tips. So they'll make sure that whatever you invest is protected against inflation. Maturity, as we discussed, the length of time over which the bond promises to pay the payments. And risk, there are different types. Default risk, risk that the issuer will not pay back the amount that they promised. Or there's a price risk. There's some uncertainty. You buy the bond today versus yesterday or tomorrow. It'll have a different price associated with it. So you might get in at a high price or a low price. So there's a price risk associated. And there's yield to maturity or yield. Think about this as one number, the interest rate that's associated with bonds which have multiple maturity. So you buy one bond and it has internally multiple maturing bonds, and the yield to maturity is the yield is one number that you can think of. It gives you the interest in aggregate of that combination. So if you understand this bond market scenario, then when we use some of these terms, it becomes easier. Yeah. So now let's take an example. If I were to hold a 1-year bond, which is a bond that matures in 1 year, or a 2-year bond, it's a bond that matures in 2 years. How does that look like if after a year? Both of them, a 1-year bond after a year, a 2-year bond after a year. Well, this is what the returns would be. A 1-year bond after 1 year, let's say you invested $1, you will get $1 times 1 plus IT. We looked at that earlier. A 2-year bond a year from now would be $1 that you invested times, so divided by the price that you paid for that 2-year bond when you bought it. So if you put $1, then $1 divided by price, that's the quantity of the amount of units of bonds that you got, which is the $1 invested divided by the price, times the price a year from now. Yeah, because this is a 2-year bond. So the expected price a year from now, you multiply price times quantity, that would be the value of a 2-year bond a year from now. Yeah, quantity, price a year from now, expected price a year from now. So what do you think? Should both of them be the same? Think about this. Yeah, the value of the return from holding a 1-year bond a year from now, would that be the same for a 2-year bond that you hold a year, and a 2-year bond that you hold a year from now? Think about this. There is no risk associated with holding this bond. You are guaranteed to make this payment. But there is some risk associated with holding this bond because there's some expectation around what will happen on the price a year from now. So this is slightly more risky. Yeah. And so there's going to be some amount of term premium associated with it. We covered some of these terms earlier, so look at that. But in a sense, a 2-year bond will have um, interest or a yield that would be the average of what expected interest a year from now and a 1-year bond interest. But as we just talked about, there is some amount of term premium associated because there's risk associated with holding a 2-year bond. Yeah, so the interest rate on the 2-year bond would be the average of um, interest rate for the 1-year bond plus expected interest rate for this a year out and the term premium associated with it. Yeah, then this would be equal in some sense to compare them. And in a sense, if you want to look at price and interest association, if you invest $100 and you get 1 plus IT as the interest associated, IT as the I1T or interest of a 1-year bond associated with it, you get the price of 1T. Yeah, price associated with a 1-year bond. Or you read this as price associated with a 2-year bond and an expected price for a 1-year bond a year from now. Yeah. So what are we trying to do here? The key insight here is, folks, you need to understand this piece, which is the term premium associated with holding a 2-year bond versus a 1-year bond, and how a year from now there's some amount of expectation baked into a 2-year bond versus you're guaranteed to get the return because the bond has already matured. This bond has not yet matured. Yeah. So there's going to be some price movement, and there's going to be some time risk associated with holding. A lot of things can change around it. So that's the key takeaway when you hold longer duration bonds. Yeah. Why is this important? Because if we look at different bonds with different duration, look at this one. If you now plot this yield curve, knowing this premium is, and what is expected premium and what is expected interest rate is connected to how we interpret the yield curve. Yeah, if you plot different yields that a given bond gives for a given maturity, like a 3-month maturity bond giving you 3.5%, a year uh, a 1-year maturity bond giving slightly less than 3.5%, and so on and so forth to 2 years, 3 years, 30 years. You see this curve, and when we plot this curve, we call this a yield curve. At any given point, any given day, you can look up the current yield curve. I picked up this yield curve from June 2001 for a reason. There is some really good characteristics about this curve. It has a positive slope, yeah, meaning it's bondholders during June 2001 or new bondholders would get a higher return, higher yield, about 5.5%, for holding a longer duration bond compared to a shorter duration bond that get 3.5%. So it is a positive slope yield curve. Most yield curves um, during most of the time will be a positive slope yield curve. Yeah, and we understand few things from here. Yeah, what's happening is the yield is higher here compared to here. Yeah, and primarily because of this time risk associated with it. Yeah, you just saw this with a 1-year and a 2-year bond comparison. You expect higher interest rate even if you just go to 2-year. So if you go to 30 years, you would have higher expectation of interest rate because of time risk associated with it. Yeah, there's price um, that can be different. There could be a lot of changes from now until 30 years. So there's a price risk as well, which the time impacts the price. Yeah, and that has an impact on the yield. So investors expect higher yield for longer duration. Yeah, and this will become much more clear because just 6 months before this period in June 2001, we saw a yield curve in November. 6 to 8 months before, we saw a yield curve that was different, almost opposite. You see, there you get a higher interest rate for a shorter period and the interest rates goes down, 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 down. Not at the level of the increase here, but it's still you get a higher interest rate for short term compared to long term. And this blue line is the November 2020 yield curve, is what we call the inverted yield curve. Because now if we can compare what's happening in the minds of investors and how we interpret this to forecast what the market is estimating the Federal Reserve will do a year from now, 2 years from now, 3 years, 4 years, and so on. Yeah. What is going to be the impact of interest rate changes into the future? This is market consensus. This is market telling you how much yield you will get if you were to hold a 3 month versus a 30 year bond. And so this is expectation. Yield curve, in a sense, is the aggregate expectations of what yields people expect for holding different maturity bonds. Yeah. And so this is expectations of people, the expectations of the market. Whether the Federal Reserve will do exactly this or not, we will see with an example, but this is what the markets expect. And remember, bond prices and stock prices are completely dependent on market expectation. And yield curve is a view of consensus view of the market as to what the market is expecting the yields um, to be buying, let's say, a 3 month bond in November 2020. They expect more than 6%. They'll not do with 3.5%. So let's now go deeper into this. Yeah. So what's happening? Why is this yield curve just 7, 8 months before inverted or a negative slope versus a positive slope for June 2001? So let's look at this in quite a bit of detail. So this is a negative yield curve description that I'll share and a positive yield curve description. So what had happened is in November 2000, during this time, the reason why this was a negative or an inverted yield curve is there were fears about US economy slowing down. Yeah. And by that, the market expected that the Federal Reserve, the US central bank, will cut interest rates so that the economy will not slow down and go back up. The growth rate will not slow down. So the economy slowing down, the market expected that the Federal Reserve will, you know, to boost up the market, will cut the interest rate. Yeah. So Federal Reserve would cut the policy rate is what the expectation was, because it was not the market or the GDP, the output, the activity was not in good shape. And so that's why there was a negative yield curve. Why? Because if there is an expectation that the growth is slowing, what happens then? If growth is slowing, inflation is expected to go down. The Federal Reserve will cut the rates, or will reduce the rate so that the output goes back up. Yeah. And when there is an expectation that the Federal Reserve will cut rates, what do you think will happen? What that means is that folks expect that they will not be able to enjoy in the short term these higher rates. Yeah. And so what happens is there's flight to safety. A lot of people would be incentivized to move here and lock in this higher rate for a longer duration. Yeah. And so when a lot of people, there's flight to safety in this longer duration, the prices go up because a lot of people are coming in, prices of these go up, and so the yields go down. Yeah. So you start to see a depression in yields here, compared to what the level here is. Yeah. But at the same time, if you expect people to hold shorter duration with this risk of Fed cutting, then what would happen is you would have to compensate them with a higher yield. That's why the yields are higher. Yeah. And you exactly put an opposite scenario when markets expect that GDP will continue to grow, economy is doing really well, you will see a positive yield curve. So were they right in telling when in during this time, were they right that the market, the Federal Reserve, even if you look at June 2001, what it's telling you is that even after a year, that the Federal Reserve will not increase rates. Yeah. Were they right to assume that? Because that's what this market is telling us. in retrospect, what happened is, to expect that in June 2002, which is a year from June 2001, so which is at this point, that the Federal Reserve would not increase rate, was, and then they would start increasing after, was the market consensus. So the expectation was that, but that didn't happen. The Federal Reserve didn't increase until 2004, and so the market expectations were wrong. And so when market expectations are wrong and the central bank does something unexpected than market expectations, that has an impact on bond prices and stock prices. Yeah. And we just saw how, if there's more and more people willing to invest here, then it will have an impact on price and impact on yield as well. Yeah. All right. So similarly, opposite scenario here in June 2001. Yeah. What had happened is that the GDP had declined much more than expected. The fears were true, but it was not as dire as what they thought. It was much more dire. Yeah. And the Federal Reserve had cut interest rate, but that was expected. But they cut much more, and so the yield curve became positive after the fact, because now they expect that the economy is doing well. So there was a huge shift between investors flocking here. Now the prices are um, depressed here because the yields are low here, so prices are high here because there's a lot more people investing here because they expect interest rates would go back up. Yeah. So this is super important to understand how to, the key takeaway from here is how to interpret the downward sloping yield curve of potential output slowing, an upward sloping or a regular yield curve of GDP or activity um, as expected and growing. So that is the key takeaway, because once you can understand and look up the yield curve for the day and see how each of these yields are changing, and it changes based on actions that are done by the Federal Reserve and with this Fed rate cuts, but also various other factors. Yeah, so we should be able to understand what is the expectation of the market and how the yield curve tells us a lot about what the market expects the central bank to do. Yeah. And if you look at the current yield curve, when I'm making this video as of January 2025, it has started to go flat and positive slope slowly, because a year before in Jan 2024, it was an inverted yield curve. You start to see short-term rates higher than long-term rates, which is not the case now. Short-term rates lower than long-term rates. Yeah. So you can look at the yield curve data, and I have this really handy website, gurufocus.com/yield curve. They've done a lot of analysis about this data, about not just United States, this is the United States yield curve that I'm presenting, but across different countries and different spreads between long versus short, and how some of this inverted yield curves at different points were able to predict recessions. Um, I think 7 out of 9 or something like that. So check this website. It'll give you a lot of really interesting statistics about how you can apply yield curve to understand market expectation, but also how it could be a soft leading indicator as well in terms of recession. Yeah. Again, you have to look at a lot of other factors, but this is a really important aspect, yield curve. Yeah. So now that we've looked at stock markets, bond markets, now let's go into the stock markets. Yeah. Like we said and derived a lot of things about the bond market, same applies for the stock market. Expectations about the current and the future activity determines the stock market price as well. Yeah. So if you look at from in real terms, not in nominal terms, the stock market has gone up over a long period of time. If you look at this 30-year period, it has almost 5 to 6x, yeah, until 2023. And in real terms, yeah, and if you look in nominal terms, it's gone up much more. But in essence, stock market is the same. Like we derived the bond price, if you hold a bond, a $1 bond for a year with an interest of I1T, you get 1 times 1 plus IT, yeah, as the value of your bond a year from now. Similarly, if you invest $1 in stock, you are expected to get dividends from the stock, and you will still hold the stock a year from now, and it'll have its own expected price QT um, a year from now. And the units that you will buy is, if you put in $1, then it'll be $1 divided by the price in year T. So units times the dividends that each of these units will give, plus you will have the price at that point a year from now. So, like we did for bonds, we can do the same for stock. $1 now is equal to, in a year from now, dividends that you will collect, plus you will get the price of the number of units that you hold, which is 1 over the price for when you bought it. So if we think about this, holding stocks and bonds, it should be at equilibrium. Expected rate of return, would be the same. Yeah. If and then you can equate these two, but remember we have to equate with um, we would have to equate that with the time risk associated with it, like we covered previously. So equity and bonds. Yeah. If you expect net, this is what you expect. Yeah. You have a year from now, this is what you get from the bond market. A year from now, you expect from the stock market. Yeah. And it's normalized to the fact that you, whatever interest you get, and you have time risk associated with it as well. Yeah. So then what drives the stock market price? Yeah, which is this thing that we derived, dividends that we get over time. We can say that we can generalize this to, you know, infinite dividends that we will get for the life of the stock. And that's all. That's all of the cash flow that we'll get. So expected dividends in year T plus one by real interest rate. So we can convert this from nominal, which we did previously, to real. And so, in a sense, the stock price is driven by the dividends that you get, inversely driven by the interest rate and the time risk premium associated with holding the stock. Yeah. So, those are the three implications. If we understand what drives the stock price, it's three things. How much is the expectation of future dividends, infinite dividends that you will get for the life of the stock? What is the expectation about interest rate, real interest rate? And then what is the equity risk premium that you are willing to give for investing in the stock? So that's it. Yeah. If you want to understand the stock price, why it moves over a long period of time, again, short period of time, there's a lot that goes into moving a stock price, but a long period of time, you could say this is the total dividends, the cash flow that I'm expecting to get, all of my cash flows divided by the real interest rate, because you'd have to also discount it back. Remember, we started this video from a year from now, dollar is not the same dollar here, so we'd have to discount it through this factor. Yeah. So that's what drives the stock price: expected dividends, real interest rate, and equity risk premium. Yeah. So if we understand this, then we can understand the impact of an expansionary monetary policy. Yeah. What happens when the Federal Reserve detects through various data that it collects that there is a recession expected in the economy? What would they do? Well, they will cut the interest rate. Yeah. And when they cut the interest rate, we've seen the liquidity money LM curve shift down. Yeah. And by that, they would expect the output to be boosted up. Yeah. So that for various other shocks, this can be a positive move up. But then, will this lead to the stock market? Can you think about like what would happen to the stock market when the Federal Reserve cuts the interest rate? That's the key question. Yeah. So, well, it depends on three things. Whether the stock market goes up. Yeah. Again, remember we derived this equation of price of stock, expected dividends time T plus one divided by um, the interest rate that we have and the risk premium. So the markets could go up, it could go sideways or no change, or even it could go down. So what it depends on is the expectations. Yeah. If the rate cut expectations are fully baked in, yeah, then the markets would go nowhere. It'll go sideways. Stock markets would go nowhere because the expectations were baked in already. So this formula already tells us that this expectation is what exactly the Federal Reserve did, exactly what the markets expected. Then the markets could go nowhere. But if this move, the real interest rate that we were using to get the discounted cash flow and then derive the price, is much higher cut than what the markets expected. Again, this whole chapter is about expectations. So the stock markets would go up if the expectations of what the market expected. You can think about the yield curve as to what they expected and what actually the Federal Reserve did. If it is highly unexpected in a positive way, meaning they cut much more than what the market expected, the stock markets will go up. Why would they go up? Because that means that the R rate that they thought is much higher. Yeah. Cut, so it is a much lower value. Yeah. So all of a sudden we will see that when there is lower interest rate, there will be higher price associated with it because activity would go up. Yeah. And so those activity or higher output will eventually lead to higher dividends, and higher dividends will lead to higher stock price. Yeah. So it depends on what was the expectation. Similarly, opposite, if the market expected the rates to be the cut to be much higher, and the Federal Reserve did a much lower cut, then the stock market can actually fall. So now you can understand what happened here with stock prices moving up or down or going nowhere depends on market expectation. And you can look at market expectation and find out what the markets expect very clearly with the yield curve. Yeah, because that's what the market participants are willing to buy those bonds at that rate. And that tells you what they expect in aggregate, the market, the Federal Reserve's action as one potential indicator. Similarly, let's assume that now we have a positive shock where the consumer spending report shows stronger than expected impact, stronger than expected spending. So what that happens is we know that the IS curve shifts up. Yeah. Now the question to you is, what would happen if the stock price will go up if you see a positive consumer spending, because these spenders are buying your goods and services? Would you expect your stock price to go up? Again, the same answer. It depends on what is the expectation and how much is that expectation already baked in. So stock markets would go up if the expectation was that the Federal Reserve will not increase the policy rate. Remember, if the consumer spending goes up, the Federal Reserve could see that as a sign of excessive activity, output higher than potential. And if the stock markets go up, that means that the Federal Reserve will not increase the policy rate. Yeah? That's the expectation baked in. Um, but if the markets expect that the Federal Reserve will look at this excessive consumer spending and be worried about inflation, then they will actually increase rates, so they can go from R to R dash, and so then the output go nowhere, and output goes nowhere, dividends go nowhere, and so the markets remain stable. So stock markets is a really good indicator, and it could go nowhere if what the increase or decrease that the central bank did was in accordance to expectation. Yeah. So the key takeaway, folks, is the stock prices change based on differences in expectation. If the expectation was higher than what the Federal Reserve did, then the stock markets would go down. If expectation was lower than what the Federal Reserve did in a positive scenario, um, then all of a sudden you expect a positive or negative momentum. Yeah. So understand what is the role of the central bank, what are they doing based on the expectation that's baked in. And if you understand that market participants have some sort of expectations baked in, and if the central bank looking at the shock being positive or negative, how the central banks react compared to the market expectation will have a huge impact on the stock price movement. Yeah? That is not it. There are various phases in which stock prices could change irrationally. In this case, an example of an asset, tulip bulbs, um, were traded, the trade, if you start to see the tulip mania of 1636 to 37, um, at one height, one of the the tulip bulb, which is a bulb, is what grows into a tulip plant with that flower at the top that looks like this. And there was this a specific bulb with like a specific color pattern, and that went for one bulb went for 7,500 guineas, or Dutch guilders. Yeah, so this is guilders. Uh, in a sense, that in today's term is equal to 10 to 20 million dollars. So you could buy a big house with big mansion with a big farm, and you could do a lot with that money. But that one bulb that would grow into this unique tulip, uh, and eventually it would die, right? That was worth 7,500 guineas. So that's huge. So there are bubbles, there are these irrationalities in prices that keep happening. So you cannot say fully that it's just based on um, expected future value. Here, there was hopes that this person would be able to sell it to this person would be able to sell it at higher for this person. So some sort of a Ponzi scheme, which can also drive asset prices. So what you're buying in terms of bonds and stock, you need to be sure whether you're participating in an active bubble with no real intrinsic value tied to the asset that you're buying. So it's super important to even apply it and think critically, where there are lots of positive and negatives about Bitcoins, but think critically about what it gets, what are the practical applications. There are lots of pluses, but there are also lots of minuses for Bitcoin. So how that falls into this category or not would be a good debate, and a lot of people would have positive sides, negative sides about that as well. Similarly, what we saw recently is the U.S. housing um, price index go up much more compared to the rent index. So this is a ratio of house price index over the rent index from the book. And I also have a link here that gives you the actual data from Fred as of today. But in a sense, when the prices were going up from 97 to 2006, there was no real agreement as to why this is the case. There were some pessimists who were saying this is a bubble, some optimists saying this is supported by real fundamental decrease in real interest rate, as we saw over time, and so the rents were much more valuable. So when bubbles get formed, in retrospect, it was clearly a bubble. But even now, if you see today's prices, it's actually gone up to those 2006 levels and slightly corrected as of now. So, the key question is why this asset prices go up so much more, and how can you detect whether you are part of a bubble, and you know and what are the factors for it, like Robert Schiller during this rise, he was clearly a pessimist who said housing market is in a bubble, the home price index is a bubble, right? And he said current and expected rents and interest rates would drive home prices, but there was no real understanding as to why there was such a steep rise in the house price versus rental index that had not gone up as much. Yeah. And the optimists were saying this is not a bubble. Back then, they were saying the real interest rate, as we saw here, was declining. So the value of rents was actually much more. And they were saying there are a lot many buyers who are able to buy at a much larger proportion of their home. So there are many good reasons and pros and cons. Similarly, for Bitcoin, you will see pros and cons. You have to really understand um, what kind of comfort you get and what kind of intrinsic value the asset that you hold is giving you, because in a sense it's all of the future cash flow that you're going to get out of it. But if it goes down to zero, that's a problem. So that's the risk you would want to look at uh, when you think about expectations in the long run. Yeah, in a sense, there are these movements and fluctuations where simple things like, this stock would really excel. Excel could be transformed into sell, 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 and then sell could eventually could say, hey, I'm out of this market. Goodbye. So then buy, goodbye could be buy, 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 right? So there's going to be these market fluctuations, and these, we saw this in the housing market here as well. Buy, 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 sell, 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 buy, 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 sell, 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 right? So you'd want to know when you're getting into some of these large, this is over like 40 years of data, right? So where are you in the cycle? Are you buying it sometime here? Are you buying it sometime here? How much comfort you have in terms of some of these assets that you buy? That's also an important factor. And what is your time horizon? Because that will have expectations baked into it. The longer the time duration you have, the larger the role of expectations of those future activity, yeah, will bake into the price movement. All right, so fascinating topic around expectation in the financial market. We'll continue on the expectations in the next chapter as well. Yeah, thanks.